Hello and welcome to episode 35 of the Money Talks. And today we've decided not to have a normal interview, but to actually open the floor for many of you that have followed the show and who have commented and who have asked so many questions to give you a chance to ask questions directly. So we're going to have an AMA session where any one of you can ask me a question, and we've decided a topic for the day is going to be personal finance for founders. And I think it's a very important topic to talk about because many founders that get started with entrepreneurship, that get started with a company, sometimes fail to understand that personal finance can play such a critical role in deciding the fate of their company. Sometimes it plays an even more critical role than their own company's finances. And it's all good to talk about that the fact that your company is going to be worth billions of dollars, and you're going to make so much money at the end of that rainbow. But to be quite honest, along the way there it's a pretty long road, and you still need a roof over your head, and you need food in the stomach while you build your billion-dollar company, or you build your fantastic business. So there's lots and lots of questions. There's lots of myths are going around. There's lots of misinformation about what you can expect as a founder who's raising money. And I think there's no better time than to ask about what is possible, what is not possible, what you should expect, what you could expect uh, as you start this journey. And it is a journey that I think every single person that goes through it gets addicted to. That's why you have so many people that are serial founders, right? And so there's some good best practices, things that I've seen, things that I've followed, things that I've even recommended to founders. And it'd be a good time to share that knowledge. So if anybody would like to ask a question, you've got a comment section below. So feel free, just ask a question, and I'll be happy to answer them. I would request that you all avoid asking any questions about fundraising. I know that's the most common topic to talk about, but this specific topic today that we're going to get into is going to be about personal finance for founders. So if you're a founder about to start, have already started, or are contemplating starting a company, this is a really good time to ask any question, anything that probably comes to mind about what should my salary be, what should I expect as my company grows? Should my salary go up? Who should I ask for a raise? What are company expenses and what are personal expenses? And I think these are some very relevant questions that keep coming to people's minds, and it's a good time to get some of those answered. So I'm just gonna give everybody a chance to ask away. Meanwhile, one of the most important factors to remember is that it's very rare for a business to get started and immediately get financing. So usually it takes about 6 to 12 months, right, for you to raise a large enough round. Obviously, unless you're a celebrated founder or somebody that comes with a lot of experience, and it can probably raise a large round of seed capital. But usually it takes about 6 to 12 months to get started, right? From the time you think of an idea to the time you put together a business plan to the time you get a company started, get it registered, get money raised for it. It takes a bit of time, and it's very important during that time to realize that uh, you know you can very easily run out of money if you haven't contemplated or if you haven't saved enough to go through this period. And many a time, I mean, I've seen this very often, that founders become very desperate because they haven't saved money, and whatever they had saved is very quickly running out. The savings aren't there, and then they're willing to take any deal that comes on the table. And at that time, you have no choice, right? Because either you go back to your job, and most likely you probably quit, and it's going to take you some time before you get another job, so you're going to get all your personal finances in a bit of a mess. Or the other option is, you take any deal that comes to you on the table, and then you rue the fact that I had to give up a massive chunk of my company just so that I personally could stay afloat. The company may be doing well, but I was doing terribly personally. and that can be a very dicey situation to be a part of. And I would definitely recommend that before you get started, right, and there is a bit of a formula that you could come up with. Just put down all the expenses that you have, right? Think about expenses, everything from rent down to even a weekly, maybe a weekly outing. If you're married, then thinking about obviously taking care of your partner if he or she is not working, or if they are working. How much money do you guys need to survive the next 18 to 24 months until your startup can actually support you, right? And that's a very weird thing to say, because it takes a bit of time, right? It takes a bit of time before your companies can support you, whether you're bootstrapping it or raising capital. It takes a bit of time, and so many a time, I mean, I get people that at the seed round start expecting 2.5 lakhs a month in salary, and the entire seed round is maybe something like you're trying to raise a crore or 1.5 crores, and it's supposed to last 18 months, and there's two founders, and each founder is expecting 2 lakhs as salary. So and it's very, as a VC, you immediately start calculating, going, 18 into 2 is 36, and then you've got two founders, 72 lakhs is just going towards the founders. And so it's not really, the money isn't really going towards the company, right? It's just going to pay the salaries of the founders, and that's not a very ideal situation for a VC to be investing into, right? We're not here to invest into your personal lifestyles, right? We're here to invest and grow your company where you guys own a majority of the equity. And our intention at any point is to be able to support. Obviously, we also want to ensure that you have enough money to feed yourself, to take care of yourself, to put a roof over your head. But obviously, seed money or even Series A money, and is not money to build savings with, right? Usually, there's someone who gave a very excellent example that until Series A, you'll probably be getting 50% of your market salary. You can probably expect market salary from your Series B or C round, and usually a Series C would take about 5 years from the time you started. So you can think about all that time. You've got about 5 to 6 years. 5 years is probably the best scenario. I've seen companies take 7 to 8 years to raise a Series C, and if you're unable to get market salaries for as long as 7 to 8 years, could you imagine how you would run your household? And that is what you need to be prepared for. So it's a, like I said, it's a very important topic. And Selva, thank you for pointing that out. So I've got a first question. I said, I think, how, let's just take it up. How do early stage startups protect against mismanagement of funds? How should I know which functions not to invest in that drain and might not yield any return? Well, you'd have to have a magic wand to really know what is going to yield or not going to yield any return. But there are certain best practices, Vidisha, that could definitely be helpful, right? I've usually felt that getting into fancy offices or getting into very high, monthly expenditure until your company can support itself is usually not a good practice, right? And so the best thing is to be as frugal, as lean as possible till you've got a business model that is working, right? And that can actually generate positive unit economics. It can generate gross profits, right? And until that is there, it doesn't make sense to be expanding your operational expenses, right? So keep your operational expenses very, very low, at least until you've got enough capital, enough revenue coming in, enough money coming in, that can start taking care of some of the perks that you see startups having. So in terms of that, I would definitely say that don't go out there and spend money very quickly. It can disappear much faster than you can think. Secondly, in terms of mismanagement of funds, I think it's a very broad topic, but one of the ways to mismanage funds is to first make a budget and then not to follow it, right? And I see that very often, that many founders think of the budget as an academic exercise that's just there so that your VC or your board is off your back. But honestly, last year was a great example of why a budget and living by a budget can actually save companies. We had to go back and redo budgets within a month of the lockdown. I mean, within that month of the lockdown. So March, most budgets were passed before March 31st, and March 22nd, 2020 we go into a lockdown. So essentially, now whatever plans we had for the first quarter are completely washed away, and from there that point onwards you have to redo your entire thought process of how you're going to run the year. And you have to cut any expenses that are not going to yield revenues. You have to cut so many. Sometimes you have to let go of people that you might have just recently hired, because whatever function you were hiring them for, that function is no longer there. And then you cut everything down to a budget, and you see, okay, how much time do I have before I run out of money? And in our cases, each and every company, we ensured that they had 18 months of runway. Right? That we ensured that at least they had enough money to get through this tough period. And so if some of these companies were falling short, then we tried raising some additional rounds of capital, right? Or at least we found ways for them to even pivot and generate other revenues. But if you do not follow the budget that you have built, right, then you're mismanaging your funds, because you're eventually going to run out, right? And this money, if you don't manage it properly, can go away very, very quickly. So it's very important that you follow the budget. Again, there is no way in the world that it's possible that whatever budget you set out, you're gonna hit the numbers to the last decimal. But what is important is that as you go through those each and every month, you realize which one of those assumptions are overweight or underweight on, and then adjust your budget as you go along. And as you're adjusting that budget, keep looking at that bottom line number, which says, how much money do I have in the bank account today, and what is my current burn rate. So that's the numerator and the denominator, and whatever the number comes out, that's the number of months you have before you run out of money. And as you get to that 6 month mark where you have less than 6 months of money, you need to start cutting expenses and increasing revenues. So that's if you don't follow your budget, I think that's gross mismanagement of funds. Let's take another question. Let's see. What are some ways for founders to generate liquidity from time to time using their vested stocks? Great question. See, usually your vested stocks will have no value until you have a growth round of equity, right? And you have to remember that as a founder, there's at least what I call it a stacking of shares, right? So you usually have common equity, which has almost the most basic rights available, and then above you will be the seed series CCPS. Then above you will be the pre-series A CCPS, then the series A CCPS, and the series B, and so on and so forth. So essentially, the more rounds you raise, the lower you are on the on that hierarchy, which means anybody holding your shares would have lower rights than everybody above them, right? And that it's sort of a waterfall. So the person who comes in last usually has the highest amount of rights. Uh, and if you're trying to liquidate shares before a growth round, right, before you have a significant amount of equity capital coming in, usually it's a very bad signal for other investors. Unless of course there is some calamity, and you need to liquidate those shares to meet some contingency that you had not planned. But other than that, right, if you're trying to liquidate shares before you've raised a Series A or a Series B, I would prefer post Series B. If you start liquidating shares, it usually has a negative connotation to it, and most VCs would very heavily discount your shares. Right, it would probably be selling for anywhere between 40 to 60. I've seen 80% discount to the primary round. So imagine, after doing all that effort, after you get a Series B round, and suddenly you need to sell shares, or you want to sell shares, and you have to chop off 60% of whatever the value of that last round is. Yeah, it can be pretty jarring. So usually, what I would recommend, or I would recommend most founders to do is wait as long as possible. Hold out as long as you can. The longer you hold out, the more the value of the shares. Usually, as you get into those later stage rounds, there's a lot more demand for your shares, right? And at that time, you could see discount rates being even lower. I mean, I've known some founders that have sold at par value, but it hasn't come in the earlier rounds. It's come in the later rounds. So just make sure that you hold out as long as possible. That's why it's personal finance is so important. You start selling shares at Series A, you start selling shares at a pre-Series A round as a founder looking for secondary, you're gonna lose the company very, very quickly, right? And not only is going to affect the value of the secondaries, but usually a founder selling shares very early in the journey is also a very negative connotation for your primary valuation. So you're hurting yourself twice. So yes, as long as you can, just avoid selling your shares until you've got significant value built in, and and then you can start liquidating. And you probably will get the highest value of your shares post CDC. So yeah, let's see. We'll take another question. Cool. I think we've got. Um, Let me take Jashrang's question. To expense or not to expense? That is the question. Any tips on how to define what expenses could be expensed out from the company and what not? Yeah, I think that's a very valid question, especially because as a founder, when you get started, the company obviously is yours. You get to decide what is a business expense, what is not a business expense. You get to decide perks. I mean, I've known and I've invested in companies where founders were generating profits, and they were generating lots and lots of profits, and because they were generating profits and they did not have any investors until we came in, they were free to use the money however so they wanted. So they could buy cars, they could expense all the fuel and everything on the company, and it was okay because the founders were effectively the owners of the company. There was nobody else on the cap table. But as soon as the investor comes in, it's no longer your company. Any asset that you have on that in your asset register is no longer just your asset. Even if an investor holds 1% equity in your company, technically they own 1% equity inside whatever exists in that asset register. So whenever you're using company assets, and it's a very good practice, not just from an investor point of view, but it's also a very good practice um, from a company culture point of view, right? It's very important that your people understand that you follow the culture of segregating personal expenses from business expenses, and that you're not expensing personal expenses as business expenses, and then because once you start doing it, then your people start doing it, and once they start doing it, then yeah, then once you have bad culture flowing around, it comes back and haunts you very, very quickly. So one of the things that I've always believed is that if you have a doubt whether it's a business expense or not, it usually means it's not a business expense, right? So then it's a personal expense. So if maybe you could afford personally to buy a iPhone Pro 12, but maybe your company can't afford to. So in that case, you buy the iPhone Pro from your own salary, or you buy that from your own personal books, and maybe the mobile phone bill, because you're usually using it for business, and probably a majority of the calls are the business calls, and maybe the monthly bill for the mobile phone can be paid by the company. Similarly, things happens with and there's a example where we had a profit making startup that we invested in, and they had a car that the company was paying for until we got onto the cap table. And at that time, we had a very candid conversation that, listen, this is now that this is no longer just your company and we're investors on the cap table, this car needs to either needs to be moved to your personal books, or you need to take that as a part of your CTC. And the founders obviously very mature. Obviously, they knew what they were doing and why they were raising money despite making profits. So they very quickly segregated those assets out, and things ran very smoothly from then on. Uh, let's see. Let me start taking another question. Hopefully, just not have answered your question. Um, let's see. There's a question from Darshan Sharma. Darshan asks that, as a founder, I believe in the old school model of breaking even first, then real doable numbers. However, I notice it's not a super attractive proposition for investors, and many pass it without even understanding the possibilities of a business. What would be the one way to make this a good proposition for seed investors? So, Darshan, unfortunately, this is not a question on personal finance, but I will answer it only for one reason, that you know, you have to understand, not all businesses are VC investable businesses, and VCs are not interested solely in businesses that lose money. I think that's a very common misconception. But what we're really interested in, because the capital that we get, the capital that we're raising, is very, very high risk, high cost capital. So usually a VC fund is supposed to return, at least in India, somewhere between 25 to 45% IRR at a portfolio level, right? Which means on an individual investment level, assuming that 80% of our investments are going to fail. Let's just take that number, right? Some people have it, one out of five. Some people have it one out of seven, but let's say 80% of your investments are going to fail. Um, that means if you have to generate 45% IRR, it means that a single investment should probably be generating somewhere close to 150 to 200% IRR. Now, that level of IRR probably requires some pretty serious level of growth. And not all the time can every business support that kind of growth, right? And therefore, while your business may be profitable, it may be a really awesome business, it could be doing really well, it probably could not be a VC investable business. And it's not about you making losses or making profits. It's just sometimes about how quickly can we see that business grow and can it deliver the kind of IRR that justifies the capital that we have raised from our investors. See, our investors are our customers at the end of the day. So they've got obviously buckets of capital that they have to put in. They've got capital for fixed income, they've got capital for the equity markets, and we have to compete against all of that and ask for them to invest in our fund, obviously promising something better. The opportunity cost obviously being the Indian stock market. Now, if I can't return something way better than the Indian stock market, why would they invest in my fund? Right? And for that to happen, I have to invest in businesses that can deliver that kind of alpha. And for that to happen, not every single business that looks good and that delivers profits could actually deliver the kind of IRR that I'm looking for in a business. So hopefully that answers your question, Darshan. Let's see. We've got Let's see, Pranav, let's take a look at the question. As an early stage startup, we are currently trying to raise a seed round and actively looking for smaller checks through safe convertible notes. Safe investors ask how to cash out when the fundraising doesn't come in place in time. Does getting in safe notes affect the valuation? Pranav, I don't know whether you're from India or whether you are from the US, but because in India we usually don't have safe notes, we have a CCD. But even let's just take it there, them as the same thing. Usually, what happens is that you raise a convertible instrument like a safe or like a CCD with the sole intention that you don't want to get into the whole conversation on valuation or on rights in the current scenario. You want to raise money very quickly, so usually you would raise money through a CCD or a safe route, and then leave the onus of the valuation to the next investor. And usually the way you compensate the guy coming in is you give them some sort of a discount to the next round. In the US, they also pay an interest. So usually the interest could be 6 to 10%, and that interest is not paid in cash, but usually converted into equity. And so until the safe converts the equity, the interest keeps on paying on that note, and then all that principal plus interest gets converted in the future at the time of conversion when there is a qualified round happening. Now, until that moment, usually that money is a debt on the company. So if the company decides to fold up and there is any assets left in the books, the first right on those assets goes to the people that hold the debt. So that obviously would mean that your safe holders or your CCD holders have the first rights to all the assets on your book. But in some cases, it could also happen that you're doing well, but you're unable to raise any capital. In India, usually you have some sort of a sunset clause or some sort of a, that if you don't raise the money in the next 12 or 24 or 36 months, then there is a floor valuation decided at the time of doing the CCT, and if you're unable to raise around, then we convert at the floor. In a safe, again, you could have a situation where after a while your investors may want to take an outside valuation and decide whether that meets the threshold or is below the threshold that they had decided would be the cap for these CCDs or these safes, and at that time convert at that valuation and get their equity get their safe converted into equity. uh, it's a rare situation, but it happens way more often than we would like to acknowledge. Let's see. Yeah, Piyush, I think it's called the iSafe. It's not a traditional safe. I know 100 VC does use the iSafe. It is not a traditional safe. The traditional safe that exists in the US, I think, again, I'm not a lawyer and not a company secretary, but I think that the way the safes were thought about in the US is not. It cannot happen in India. It's not as simple under the Indian Companies Act. But yes, 100x VC does use does use what's called the iSafe, and they but it's effectively a CCD document, which is a compulsory convertible debenture, where they decide a floor valuation, or sorry, a ceiling valuation, and a discount rate based on the next round valuation, and then that's how they convert their money into equity, which is all left to the next investor to decide, which is very exciting and interesting, especially in the early stages, because you no longer have to go through the long process of issuing shares, and there's a lot of cost that is attached to that. With 100x's model, especially at the early stages, they're just leaving all the rights and all the valuation questions to the next investor, which is very exciting. I think Sanjay has done a fantastic job in making these ISAs popular, and hopefully there'll be someday that we can have the real safe version of the US style, which Sanjay, through his efforts, can probably bring to India. Let's see. Sriram has a question that says that what is actually considered as traction for an early stage startup if the startup is not into monetization, is still giving service as a freemium kind of stuff? Yeah, I mean, it depends upon how you're defining your metric, right? I think Facebook wasn't making money for a long time, and they obviously had a lot of engagement early on, and but they were very clear what they were trying to do, right? They were trying to give you access to free stuff online to collect all your data and then decide how to monetize it. So it really depends upon why are you giving free stuff, and what are you getting in return? Are you collecting data? Are you understanding behavior? Like, what are you trying to do with whatever that's free stuff that for whatever reason you're not charging to your customer? And if that is very clear, most VCs will be willing to look into uh, the hook, and then figure out what exactly how you're going to monetize it in the future. Um, but yeah, if you're just giving free stuff and you have no idea why you're doing it, then obviously that's not something any investor would be willing to burn their hands over. Um, let's see, sorry, I am a bit butterfingered right now. Let me see if there's another question. Okay. Selva Kumar has a question. What are the metrics you are following for tracking investments, since most startups are started bootstrapped? So usually, the usual stuff, right? I obviously calculate an XIRR I used to do it every month, but now the portfolio is too big to do it. So at least on my personal portfolio, I do it probably once every 6 months or 12 months, because there's just so many rounds happening, and to keep updating my sheet would probably take a significant amount of my time. Um, but on the fund side, we do provide a monthly understanding of where things are, more in on what's called an MOIC, on a multiple on invested capital basis. And usually, what we do is that we take the last round valuation that was decided in the in whatever last round of financing happened, and then how much ever money we've put in, and we divide the numerator by the denominator, come up with a what is our multiple on the invested capital, and that is usually how you track it, at least during the year. And then probably once a year you go out and you figure out, okay, what's my XIRR, what is my how much cash have I actually got out, in the, you usually call the DPI, distribution over paid in capital. And once a year, I would at least track the DPI for my personal portfolio to figure out, okay, how much exact money have I been able to uh, withdraw versus the amount of capital that I've invested. Because the MRIC can obviously be a paper kind of evaluation to give you an indication of where you are, but what investors and what all of us would like to see at the end of the day is not the paper valuation, but the exact amount of money that comes into my bank account. So until you have to track both of those, and that's usually how I do it. One of the things I always do as well is Silva, is that always compare myself to the Sensex, or sorry, to the Nifty. Usually the Nifty small cap, right? Because that usually moves, uh, much. It usually has a higher beta than the Nifty 50, and so therefore if the Nifty is going up, the Nifty small cap is used to going up much quicker. So I need to beat that by a good margin, because I'm usually obviously a little more riskier than the Nifty small cap. Again, the question of what is risk. If I ask Abhishek from last week, who was on the show, he would probably take an hour answering that question and convince us that um, that unlisted investing and listed investing, that the risk is the same because they're both investing in equities. I personally believe that listed equity markets have become very volatile, and it almost feels or almost seems like the private equity markets are probably a lot more stable, in especially during short-term crises like a COVID or like the European debt crisis. They're a lot more stable than compared to the the public markets. So, but I always compare that just to make sure that am I being able to beat that with a good margin? And if I am, then obviously my investments are doing well, my picks are good. Otherwise, my family would be asking me to invest the money in the listed space. Let's see. Let's see if there's any other questions. Oh, there's a lot of questions. Oh, Suresh Rangarajan asks, how much personal funding is too much risk for a founder? It's again depends on the conviction of the founder, but I would usually say that probably not a good idea for a founder to bet every single penny that they have on a single business idea. Obviously, a significant amount of your personal wealth is going to get created by your business. So let's not forget that once you have a successful business, a significant amount of your personal wealth is going to be in your business, and you can't deny that. But you also cannot deny the fact that most businesses are do fail, and usually the thumb rule is that 8 or 9 out of 10 businesses will fail in the first 10 years. So you obviously cannot put every single penny you have in there unless you've got a temporary anomaly that you just need to get over. But there cannot be a one answer that fits all situations kind of thing over here. So to everyone his own. But I would definitely not bet every single thing I have on a single business idea, right? Until I have execution and I can see that whatever the idea I have in my head is actually something that is playing out in the real world. Until and unless I see that, I'm not going to bet every single penny I have. And even then, I would probably hedge my bet a little bit. I obviously I'm never going to be in a situation where if I have a running idea and I'm running short of capital and I have some that is in my house that I'm not going to deploy it. But I'm also I'm very clearly distinct, trying to make a distinction between a business idea and a running business, right? They're two different things, and ideas are tend to fail much more often, or probably way more often than a running business. So you got to make your peace with that. Um, let's see. Karthik, great question. I'll instead of answering it here, I'll just ask my team to get in touch with you about getting on your platform. Great question, Akhilesh. I think this is a very, very important question. That if is it acceptable if a founder building a product takes a part-time job consulting or doing business development, etc. Honestly, every founder should do that, right? Every founder, until they've got a viable business, until the business idea gets into execution mode, starts generating revenues, it's completely okay. I think it's not even just okay. I think it's a very important thing that you keep earning some revenue on the side, because you don't want to completely burn out the savings that you have just while you're in the building phases, right? Remember, I was telling you earlier that it takes about 5 to 6 years at a minimum until you will ever see market rate salary, or what the market should actually pay you. It'll probably take you that much time until you'll ever see salary that can actually match up to what the market owes you. And until then, you have to make every rupee stretch as much as possible. And if you can find ways to put some rupees into your personal savings, do that. Right? If you can find some ways to put some money into that personal savings account by doing some consulting work, by I mean, I've seen people do all kinds of crazy things. One of our founders actually even rented out, because to save money early on in the business. Actually rented out one of the cabins to a CA and charge him rent, and then that would reduce his overall rent outgo. And that was brilliant. I mean, I think just tells you how cost conscious this person was and this founder was, and I was very amazed, very impressed with that kind of thinking. So I would not deny. I think there's a huge gig economy out there, Akhilesh, and if you're in the building phase, if you're in the even in the early stages of your company, and you've got some, you can spare some time and make some extra bucks, and make that savings account stretch as much as possible till your business can support you. Should do it. You should not even think twice about it. I don't think anybody would, any investor in the right frame of mind would hold that against you. Let's see. Great question, Ankit. Thank you for the insightful session. What are your thoughts about a war chest or an emergency fund? About both, how do we decide how much is appropriate? It depends upon which city you're in, right, Ankit? I think in a city like Mumbai, and I was just doing some back of the envelope calculations the other day, and I think to be honest, if you're living in proper Bombay, which is the South Bombay side, usually about 50 to 75 lakhs is what you require to survive 18 to 24 months without any solid income coming in. And that's counting rent, that's counting food, that's counting electricity, that's counting all the incidentals. It's even counting one outing a week. Usually, nothing expensive, maybe just a movie. I mean, no one's seeing movies today, but in a theater, but usually at least one outing a week, because you have to unwind from time to time, and also one annual break, right, that you might take. So if you count all of that, if you're living in South Bombay, usually 50 to 75 lakhs is what you require to survive 18 to 24 months, and if you're living outside in the suburbs of Bombay, the amount probably goes to between 35 to 50. I've looked at some tier 3 cities, usually a lot cheaper. I would probably say between 50 to 35 is a good ballpark, is what you need. But you essentially need about 18 to 24 months of uh, worth of money in your bank account that can survive the winter. Okay? That you're basically going to have while you're running your company. Where you're probably not going to be able to, the company won't be able to support you. They could probably pay you a stipend, they can probably pay you a bit of money, but during those first 18 to 24 months, you're literally going to be dipping into your savings to run yourself. And obviously, the numbers change if you have a spouse. And if the spouse is not working, obviously the numbers change dramatically. If you have a child, the numbers change dramatically. In most cities today, to send a child to school can be one of the the biggest expenses you have. So you have to you have to build that kind of a war chest before you go into business. Obviously, not all the time can you do that, but if you had prudent time to to build that kind of a war chest, I would say 50 to 75 lakhs in Mumbai, probably 25 to 35 lakhs in a tier 2 city, and probably a little bit 15 to 25 lakhs in a tier 3 city. So that's what would be a good ballpark to start with. um, let's see. Unfortunately, guys, I will try to avoid any questions about valuations of startups, because it's not really with our topic today. Yeah, Shashank, I think good question. If a startup is profitable and to accelerate growth, can a startup go for investment? And in that case, how to calculate risk? Uh, Honestly, I don't know how to really calculate risk for startups. I think that's a great question to ask Ashwath Damodaran, who wrote the book The Dark Side of Valuations, and he can probably do a fantastic job, like a gazillion times better than me, in terms of explaining how to calculate risk of a startup investment. Uh, but yes, I think if a startup, again, I don't know whether you mean profitable on a net profit basis or profitable on a unit economic basis, but in either of the cases, if a startup is profitable, and there is a large enough market that they can go and capture, definitely they should go for an investment. They should approach an investor. They should explain the size of the market, what kind of revenues they already have, and they'll be able to accelerate that. And how they could accelerate that growth by tapping into that capital, and really getting into uh, a sizable ownership of their addressable market. And if that argument is convincing, and if there's an actual market out there, I think people will be funding you and lining outside your door. for that to happen. Um, let's see. So let me take. I think there's a lot of questions coming in, but Jashan, great question. At what stage can a founder look at becoming an angel investor, considering one can invest small ticket sizes too in startup these days? First of all, I would never recommend writing small checks into startups. That's what crowdfunding is all about, and unless and until you can actually provide your time to a company and you can actually you see the concept of investing into startups is that you have this is the only asset class where you have some degree of control on the result. And if you're writing small checks and you're part of some massive cap table where there's 50 people writing 2 crore, 1.5 crore kind of checks, you have no control on that on the result. Like you're just one small speck of dust on a massive cap table, and it's not the ideal situation, right? What I would if you as a founder wanted to become an angel investor, I would start looking at writing checks into companies that align with my business and start investing in the ecosystem around my business, right? And try to build a much closer association over there. And usually, again, this may not come very early in the business because obviously at that point, you're not really generating enough money to even probably run your own household. So where are you going to make the investments from? But I have encouraged a lot of my founders after they've got their Series A, after they've got their businesses to over a particular level, to start investing small checks into the ecosystem around them. But those are more strategically led. They're not part of angel investment checks. They're more part of knowing the founder, having strategic alignments, stating that working together we can scale things faster, and they can probably the founder that I'm talking about, which is already established, can help the new company grow faster but may not be able to put large chunks of money. So writes small checks, but then gets very heavily involved, and then that's how you make that investment multiply. If you're writing a small check and you're just spraying and praying, or you're not able to help the company in any manner, then trust me, the listed space is way more profitable and way more lucrative than the unlisted space. So let's see. Take this question from Satish Kumar Arora. Hi, what if there is a company that is profitable and operational in distribution since 2005 and needs funding for 3x to 5x expansion over the next 3 years? Satish, I think by the definition, you're no longer a startup because you're over 16 years old. And in India, I think a company that is usually more than 10 years old, most VC funds can invest in them. So traditionally, I would say you would be probably looking for more of a private equity kind of investment, considering the amount of time your company has been operating, or maybe even bank debt. I'm not very specific or don't know any specifics about your business. Um, but in that case, once again, um, if you're looking for expansion and you've got obviously a business that has been running for 16 years, it should not be very difficult to find investors to invest in that business. Unfortunately, like I said, a 16-year-old business usually doesn't qualify as a startup under the government norms that we have, and that would not allow most domestic VC funds to be able to back your company. So would probably go after more family offices, or I would probably encourage you to look for private equity. Again, I don't know the size of a business. I have no idea. So I'm just going off the fact that you've been in business for 16 years, which is a fantastic achievement. Congratulations for that. And I'm just going off of that and commenting that you're probably big enough for a private equity kind of investment. Uh, Thank you so much, guys. There's so many questions, and just I mean, every time I try to scroll up a few, I see my cursor go down a few because there's so many questions just coming in. Um, let's see. I'm gonna pull. Um, I like this question. So Vishal Kumar Wagela asks, till what stage founders should wait before drawing a monthly salary? Vishal, founders should always draw a monthly salary. They should draw a monthly salary even when they're bootstrapping. There is no way your business should not pay you at least some salary. I think it's a very common misconception when founders approach us and they tell us that we've broken even. we're cash. We last month we were cash, net cash was zero. Like net cash going out was zero, and therefore you should invest in us. And the first question I asked them, did you pay yourself any salary? And then they say no, and then I ask them, okay, well, how much salary do you expect to pay yourself after you get funded? And then there is some number that they'll tell me. So if I deduct that number from your last month's sales number, aren't we actually losing money, right? And you shouldn't fall into that trap. It again, I'm not talking about your business being able to support some sort of a market rate multi-lakh salary, but even if it is paying 25,000 rupees a month, 50,000 rupees a month, every single month your business should write you a check, so that there is a segregation between what is the business and what is you, right? And that you are getting paid something. It may be very little, it may not be even commensurate to what you're actually worth in the market, but a business should always pay you some level of salary. And early on, it could be 25,000, 50,000, it could be 10,000. It doesn't really matter. That's not the point, isn't the amount. The point is the concept that a business should always pay its CEO a salary, right? Because you're putting your time, effort, and money. You're there the entire day. Obviously, you've got a massive upside in the equity component of the company. But that being said, your business should always pay your salary. And if you're not unable to pay yourself any salary for a particular month, you could decide to put that as as an arrear that you pay the following month or the month after. But the business should at least know that every month that there was some money owed to an X person. In your case, Vishal Kumar is owed some money because he is the CEO of the business, and there is a segregation between the CEO of the business and the shareholder of the business, right? And as a CEO, you should be paid some salary. As a COO or a CFO, whatever role you're holding in your startup, you should be paid some salary. And if that is not happening, then you are again not setting the right culture, not setting the right precedent for your company, and it's going to come back and hurt you in the end. I'm going to try to take a couple more questions over here. Um, I had planned to do this for 30 minutes, but there's truly such amazing questions that I don't feel like ending this very, very quickly. Uh, let's see. Good question, Sapna. What parameters do you use to decide what is the right salary to pay a founder, say Series A or B startup? How much percentage lower than market salaries? So there are two different ways to go about it. There was again, I forget the person that commented on this earlier this week on one of the posts that I had, but uh, what his thumb rule was that if your market rate salary, whatever your market rate salary is, your Series A, after your Series A is completed, you should probably be at 50% of your market rate salary, and probably at Series B or C, you can expect at least what is market rate salary at that time. I usually look at, because I mean I'm not a Series BC kind of investor, so I don't know how to calculate salaries there. But I would say at the early stages, I usually look at the how much is the funding round, and how much of that funding round is going to go towards paying founder salaries, and how much is it going to go towards team building and other activities that the business requires. And then I have a bit of a formula. So usually, I would say if you're two founders and you've raised a seed round, usually about 10 to 15% of the overall round is the salary you should pay yourself. So the math is very, very simple. If you raise a 2 crore round and it's for 18 months, so 20 lakhs of that should be for your founder salaries. So take 20 lakhs, divide that by 18 months over two founders, and you get a number, and that's the number that the business can afford to pay. Because whatever the business cannot afford to pay you is already getting compensated in the equity the founder holds, right? And therefore, the rest of the money should be going towards team building, should be going towards building value in the business, and not to build the founder's personal bank account. Let's see, Vimal. Vimal, sorry, you're asking questions about whether I will invest or not, and those are not the questions that are going with the current show. So please ask questions about personal finance for founders, and more than happy. I think Anup, we just answered the question, but usually the founder salary, especially if you're bootstrapping and you have no investors sitting on your board, then yeah, it would not, you can decide pretty much what you can pay yourself. Obviously, you won't pay yourself too much if the business goes bankrupt, but yeah, usually if you're raised outside money, it would be a percentage of the overall budget or the overall funding round that you can afford to pay the founders. And you know Should leave it at that. Yeah, Siddharth, good question. You posted a very interesting point on Instagram the other day. Founders shouldn't expect a 80 to 100% increment on their salaries post fundraise. How does one work around since founders are usually pulling a stipend from the company opposed to a percentage of market salaries? It's a combination of factors. That is a combination simply because a business can usually in the early stages, and this is where I exist. So I exist in the early stages of a business. At that stage, the companies just can't afford to pay anybody market rate salaries. We can't even afford to pay the employees market rate salaries. So if the company can't afford to pay the employees market rate salaries, how is the founder expecting the market rate salary, right? The founder has to set the example by taking the deepest cut from their market rate salary. Now, how can you compensate yourself during that period? I've talked a little bit earlier about having some personal savings built up, of even moonlighting and doing some sort of gig work on the side. Um, Usually, founders shouldn't expect more than 10 to 15% of the overall round that they have raised as their salary during the period. And obviously, I'm saying 10 to 15%, assuming two founders. If you're only one founder, you should probably be between eight, maybe 5 to 8% of the overall round. The remaining money is to build your team, is to build the tech and to build everything else, and it's not just about the founder. It's about the ability of the founder to build everything around him to build a viable business, right? And whatever we cannot pay them, or whatever the business, sorry, cannot pay the founder, the business is compensating to you in terms of equity, right? Because you're the majority owner of the equity cap table, and obviously, as your company grows and starts building, and you've got people around that are productive and taking the company forward, the value of your equity is going to multiply, which eventually you can sell, in later rounds, or when you have your exit, you'll have a massive check written back to you. Um, and just so I make it clear, this example that I put out, this was a founder already making over a lakh a month in salaries, and this was before he had raised his seed round. And after raising his seed round, his expectation was to be up another 75 to 100%. So and that's a pretty sizable chunk of the budget that he was raising, and that's why I think that wasn't the right culture to set, because you should not be focusing on massive raises to your salary uh, because you raised a new round. Another good way to do this is if you decide on a sales number, and if you exceed that number, then maybe a percentage of the incremental sales would come back to the founder for driving that sale. And that puts the right incentives in place. Now you put an incentive where if the company hits a particular target, which obviously makes the company more valuable, and there is, it's delivering above what it was supposed to, then maybe a portion of that upside comes back to the founder. But no, raising a funding round doesn't is not the right trigger to to make a massive raise, in your salary. I take another question. Take one last question. How about that? I think we're already at 55 minutes. I had no idea we would go this long. Um, I think Vishal Kumar, I've answered your question already. I'll take, let's see. So I'm just going to scroll up a little bit, sift through a bunch of these questions. I think I've answered a few of them. A number of them, just trying to see which ones I've missed. Um, okay, Kapil, you'll be the last person, the last question for the night. Um, Kapil's question is, what are the cardinal rules for saving and investing when you're an entrepreneur? Uh, if an entrepreneur is saving money every month, I think that's a bit of a surprise, especially in the early stages. I don't know how most founders would be able at least in the early stages save money. But yeah, I think the founders should try to, at least in the early stages, try to be as frugal as possible with personal expenses, right? Especially because business is going to need help, and whatever money you can save, and whatever money you can keep reinvesting into the business, you should, uh, as long as it's growing. And therefore, the cardinal rule, at least at the initial stages, and again, there are two obvious versions. One is the one where you bootstrap, you have no investors. So until you're profitable, the founder stays frugal as he or she can. And then once you're profitable and once your companies can support you, then you can, obviously enjoy some of that wealth that you've created. However, if another way to look at this is also if you're funded, right, and your what you should be doing at that time is try to save a little bit of money from time to time. I don't think you'll be able to save a lot in the initial stages because you'll be getting less than what you're actually supposed to get from the market. But at least in the later stages, start saving money. Start making some investments, start building a bit of a network, and eventually all of that will help you, diversify some of your wealth away from your personal business. Because as your company grows bigger and bigger, and you will realize that a massive chunk of your private wealth is in the company. I need to start diversifying that out at the right time. Probably get the help of a certified, wealth manager who can help you diversify some of those assets. But for a long time, and I can quote so many of our amazing business tycoons and business icons who still continue to hold a significant chunk of their private wealth in their companies. But again, most people are now realize, especially the people that are running family offices, that they need to diversify away a little bit from the business, from the main business, and start investing in other assets. And I think when that time comes, you should find yourself a good private wealth advisor who will guide you correctly, and then be able to uh, help you manage your newfound wealth. So I think with that, I will end the questions for tonight. Again, guys, thank you so much. I had no idea that we would go on for almost an hour. I promised my team that I would not go on for more than 30 minutes, but we've had a fantastic session, some great questions, and looking forward once again. We'll be catching up with you again next week. We'll be there uh, Thursday night, 9 p.m. Until then, good night. Take care.